Before we begin, if you value thoughtful, disciplined financial analysis without the noise, consider subscribing to this channel. We focus on evidence-based insights that help you make more rational decisions in uncertain markets. You'll find the subscribe button just below this video in red. No pressure. Just an invitation to join a community that values preparation over prediction. Now, let's address the question on everyone's mind. Silver recently crossed a threshold many investors thought they'd never see again in their lifetimes. The price surged past levels not witnessed in over 4 decades. Excitement rippled through commodity markets. Social media filled with predictions of endless gains. And then, as always happens, the inevitable question emerged. Is this the beginning of a new era for silver? Or are we witnessing a temporary spike that will ultimately reverse course? More specifically, is silver going back below $50 per ounce? This isn't a trivial question. For those holding physical silver, mining stocks, or silver ETFs, the answer affects real wealth. For those considering entry, it determines whether opportunity still exists or whether the party has already ended. Today, we're going to examine this question through the lens of historical data, market structure, macroeconomic forces, and investor psychology. We won't make predictions. We'll do something more valuable. We'll build a framework that helps you think clearly about what might happen next, regardless of which direction silver moves. Let's start with an essential truth about silver that many investors overlook. Silver is not simply a commodity. It's also not purely a monetary asset like gold. It exists in a strange middle ground that makes its price behavior uniquely volatile. Roughly half of silver's demand comes from industrial applications: electronics, solar panels, medical equipment, water purification systems. These uses create fundamental demand based on economic activity. The other half comes from investment demand and jewelry. This portion responds to entirely different forces: inflation fears, currency concerns, portfolio diversification needs. This dual nature creates a peculiar characteristic. Silver tends to be more volatile than gold, yet more stable than purely industrial metals like copper. Understanding this split personality is crucial to answering our central question. When silver prices surge dramatically, we must ask, which half is driving the move? Is it industrial demand responding to economic growth, or is it investment demand responding to monetary concerns? The answer determines whether the move is sustainable. As of early 2026, silver has experienced a remarkable run. Multiple factors converged simultaneously. Central banks globally have maintained accommodative policies longer than many expected. Industrial demand, particularly from the renewable energy sector, has remained robust. Geopolitical tensions have pushed investors toward tangible assets. But here's what matters more than the price itself: the pace of the move. Rapid price increases in any asset create their own dynamics. They attract momentum traders. They generate media attention. They pull in retail investors who feel they're missing out. These dynamics are not inherently bullish or bearish. They simply mean the current price reflects more emotion than it did 6 months ago. An emotion, unlike industrial demand or monetary policy, can reverse instantly. This doesn't mean silver must fall. It means we must acknowledge that part of the current price includes a sentiment premium that may or may not persist. Let's travel back to January 1980. Silver reached an all-time high above $50 per ounce. Adjusted for inflation, that's equivalent to roughly $180 in today's money. What happened next is instructive. Silver didn't gradually decline, it collapsed. Within months, it had fallen below $15. It would take over 4 decades for silver to nominally return to those levels. What caused that spike? The Hunt brothers, 2 wealthy Texans, attempted to corner the silver market. They accumulated massive positions, driving prices to unsustainable levels. When regulators changed margin requirements and lending rules, the scheme unraveled catastrophically. Now, the current situation is nothing like 1980. There's no single group attempting market manipulation. The fundamentals supporting silver today are more diverse and legitimate. But the episode teaches us something important. Silver can sustain elevated prices only when supported by genuine, sustained demand. When prices outrun fundamentals by too wide a margin, corrections are inevitable and often severe. The question isn't whether silver can trade above $50. It clearly can. The question is whether the factors supporting it at these levels are durable. Every asset moves in cycles. This isn't mysticism. It's the natural result of human behavior responding to changing conditions. Bull markets don't end because of a single event. They end when the forces that drove them gradually exhaust themselves. In silver's case, a bull market requires several sustained conditions working in concert. First, industrial demand must remain strong. This typically requires global economic growth, particularly in manufacturing and technology sectors. Second, investment demand must persist. This requires ongoing concerns about currency debasement, inflation, or systemic financial risk. Third, supply must remain constrained. Unlike fiat currency, you cannot simply print more silver. Mining production responds slowly to price signals. Fourth, and often underestimated, the market must maintain sufficient liquidity. When silver becomes too expensive, industrial users seek alternatives. When it becomes too illiquid, institutional investors reduce positions. Here's the challenging part. These four conditions rarely align perfectly for extended periods. Economic growth eventually peaks. Central banks eventually tighten policy. Mining production eventually increases. Investors eventually find other opportunities. The cycle turns, not because something breaks, but because equilibrium is temporarily achieved. Let's examine the industrial side of the equation more carefully. Silver's role in renewable energy, particularly solar panels, has become increasingly significant. Each solar panel contains roughly 20 grams of silver. As solar deployment accelerates globally, this creates genuine durable demand. Electric vehicles also use significantly more silver than traditional automobiles. Estimates suggest EVs use between 25 and 50 grams of silver, compared to 15 to 28 grams in conventional vehicles. 5G technology deployment requires silver for its superior electrical conductivity. As telecommunications infrastructure expands, this adds another demand stream. These are not speculative bubbles. These are real industries with genuine growth trajectories. But here's the complexity. Industrial demand is price sensitive. When silver reaches elevated prices, engineers and manufacturers work aggressively to find alternatives or reduce silver content. Thrifting, substitution, and efficiency improvements accelerate when costs rise. In solar panels, researchers have already developed techniques to reduce silver content per panel by more than half compared to a decade ago. This trend will likely continue. This doesn't eliminate industrial demand. It caps how much that demand can grow in response to higher prices. Think of it as an elastic ceiling. Industrial demand supports silver prices up to a point. Beyond that point, the support weakens as substitution accelerates. Investment demand operates on entirely different principles. Investors don't buy silver because they need it for manufacturing. They buy it because they believe it will protect or grow their wealth. This makes investment demand both more powerful and more fragile than industrial demand. More powerful because it can surge dramatically when fear or inflation expectations spike. A single geopolitical event or monetary policy shock can triple investment demand almost overnight. More fragile because it can evaporate just as quickly when sentiment shifts or alternatives appear more attractive. Consider what drives investment demand for silver specifically. It's not simply inflation hedging. Gold serves that purpose more efficiently. Silver attracts investors who believe gold is expensive and silver offers greater percentage upside. It's the poor man's gold narrative. The belief that silver is undervalued relative to gold, measured by the gold to silver ratio. Currently, that ratio sits near historically moderate levels. Not at extremes suggesting silver is severely undervalued, but not at extremes suggesting it's overvalued either. This matters because it means investment demand for silver lacks a powerful narrative catalyst right now. The ratio isn't screaming silver is cheap. Without a compelling relative value story, investment demand depends primarily on absolute price momentum and macroeconomic fear levels. Both can change rapidly. Supply constraints have supported silver prices, but this factor is often misunderstood. Silver isn't rare in the way many precious metals are rare. Roughly 80% of silver is produced as a byproduct of mining other metals, primarily copper, lead, and zinc. This creates an unusual dynamic. When copper prices are high, copper mines produce more copper. This automatically increases silver supply as a byproduct, even if silver prices haven't changed. Primary silver mines, those that mine silver as their main product, represent only about 20% of global supply. These mines do respond to silver prices by increasing or decreasing production. But the lag time is significant. Opening a new mine or expanding production takes years, not months. What does this mean for our central question? Supply is unlikely to flood the market and crash silver prices in the next 6 to 12 months. The production pipeline simply doesn't work that fast. However, if silver maintains elevated prices for 2 to 3 years, we should expect meaningful supply increases. Mines that were marginally profitable at $30 become highly profitable at $50. Capital will flow to expansion projects. History shows this pattern repeatedly. High prices eventually cure themselves by stimulating supply. The question is timing. And timing depends on factors beyond simple economics. Let's zoom out to the broader economic picture. Silver prices don't exist in isolation. They respond to forces affecting all assets: interest rates, currency movements, inflation expectations, and economic growth trajectories. Right now, several cross-currents are operating simultaneously. Interest rates remain historically low in real terms despite recent increases by central banks. This reduces the opportunity cost of holding non-yielding assets like silver. Currency concerns persist. The dollar's long-term purchasing power trajectory, regardless of short-term movements, creates ongoing demand for tangible stores of value. Inflation has moderated from peaks, but remains above the levels that prevailed in the previous decade. This keeps precious metals on investors' radar. Geopolitical instability hasn't receded. If anything, the multipolar world order creates more persistent uncertainty than the post-Cold War period. These factors broadly support elevated precious metal prices, but they don't guarantee those prices will remain elevated indefinitely. The critical variable is trajectory, not current levels. If inflation continues declining, if geopolitical tensions ease, if economic growth stabilizes at moderate levels, the urgency driving investment demand diminishes. Silver doesn't need negative developments to decline. It merely needs the absence of increasingly negative developments. This asymmetry is important to understand. Let's briefly address market structure without drowning in technical jargon. When an asset rises sharply, it creates what traders call overhead resistance. This simply means many investors who bought during the rally now hold positions in profit. If the price stalls or reverses slightly, some of these investors will sell to lock in gains. This selling creates downward pressure. Silver has also attracted significant speculative interest through futures contracts and leveraged products. These positions amplify moves in both directions. High speculative positioning isn't inherently bearish, but it means the market is more sensitive to negative surprises. One disappointing economic report, one hawkish central bank statement, one technical break of a key support level, any of these could trigger cascading selling as leveraged positions unwind. This doesn't predict such an event will happen. It simply acknowledges the market structure makes sharp reversals possible. Risk management requires acknowledging this possibility without obsessing over it. If you currently hold silver, whether physical metal, mining shares, or ETFs, you face a specific set of decisions. First, acknowledge your entry point matters enormously. If you bought silver at $15 or $20, you're in a fundamentally different position than someone who bought at $45. Your risk exposure differs dramatically. Those with low-cost bases have the luxury of riding out volatility. Those with recent high-cost entries face more immediate risk. Second, consider position sizing relative to your overall portfolio. If silver represents 5% of your assets, a 50% decline, while painful, doesn't devastate your financial position. If it represents 30 or 40%, you're taking concentrated asymmetric risk. There's no universal right answer to position sizing, but the question deserves honest examination. Third, decide in advance what would cause you to exit. Not based on price alone, that's emotional. Based on the fundamental factors that initially justified your investment. If you bought silver because you believed inflation would spiral out of control and inflation clearly moderates, that's a legitimate reason to reassess. If you bought because you believed industrial demand would surge and substitution accelerates faster than expected, that's a signal. Define your exit criteria while thinking clearly before volatility clouds judgment. Fourth, resist the temptation to become emotionally attached to your position. Silver doesn't know you own it. It doesn't care about your cost basis or your hopes. It will trade based on supply, demand, and market sentiment. Treat it as one investment among many, not as an identity or a cause. Fifth, consider whether to take partial profits. This isn't market timing, it's risk management. If silver has appreciated significantly and represents an uncomfortably large portion of your portfolio, selling a portion to rebalance makes rational sense. You maintain exposure while reducing risk. You don't need to predict the top perfectly. You simply need to manage risk intelligently. If you're considering buying silver at current levels, you face a different set of questions. First, examine your motivation honestly. Are you buying because you've analyzed the fundamentals and concluded silver offers good value? Or are you buying because prices have risen and you fear missing further gains? These motivations produce radically different outcomes. Fear of missing out is perhaps the most expensive emotion in investing. It causes people to buy assets at precisely the wrong time, after major moves have already occurred, when risk-reward ratios have deteriorated. If you're considering silver primarily because of price momentum, reconsider. Second, understand that buying after a significant rally means accepting lower margin of safety. Margin of safety doesn't guarantee profits, but it provides cushion against adverse developments. When silver trades at $20 and you have strong conviction it's worth $30, you have margin of safety. When silver trades at $50 and you believe it might reach $60, your margin has shrunk considerably. This doesn't mean you shouldn't buy. It means you should be honest about the risk-reward profile. Third, consider dollar-cost averaging rather than lump sum investment. If you believe silver has long-term value but acknowledge short-term volatility, spreading purchases over several months reduces timing risk. You'll avoid the regret of buying everything at the peak. You'll also avoid the regret of waiting indefinitely while prices potentially move higher. Fourth, think about how silver fits within a broader portfolio strategy. Silver shouldn't be an isolated speculation. It should serve a specific portfolio function. Inflation hedge, currency diversification, Industrial commodity exposure, whatever role you've identified as valuable. If you already hold adequate gold for monetary insurance and adequate stocks for growth, adding significant silver exposure may not improve your portfolio's risk-reward characteristics. Fifth, be prepared for volatility. Silver can easily decline 20 to 30% within weeks. Not because fundamentals changed dramatically, but because sentiment shifted. If a 20% decline would cause you a panic or force you to sell at a loss, your position size is too large. Size your investments such that even a 50% decline wouldn't materially impair your financial well-being or sleep quality. Let's be explicit about behavioral pitfalls that destroy wealth in volatile markets like silver. When silver drops sharply, panic selling locks in losses. When it surges, euphoric buying at peaks creates them. Emotions are designed to protect you from physical danger, not to generate investment returns. Leverage turns volatility into catastrophe. A 20% decline in an unleveraged position is painful but survivable. A 20% decline in a 5x leveraged position wipes you out completely. The promise of multiplied gains blinds people to the certainty of multiplied losses. If you can't afford the position without leverage, you can't afford it with leverage. Silver is not a lottery ticket. It's a volatile asset that may or may not appreciate over your investment time frame. People who approach it with unrealistic expectations invariably become disappointed or take excessive risks. Concentration in any single asset, particularly one as volatile as silver, is speculation, not investment. Speculation isn't inherently wrong, but calling it investment is dishonest. If you choose to speculate, do so with capital you can afford to lose entirely. Silver must reach $100. Silver can't go below $40. These statements reflect hope or fear, not analysis. The market doesn't care about your price targets. It will trade wherever supply meets demand. A 3-day decline doesn't mean the bull market is over. A 3-day rally doesn't mean you should mortgage your house to buy more. Short-term noise tells you almost nothing about long-term trajectory. Yet people obsessively track daily movements as if they contain profound meaning. Without predetermined exit points, you're forced to make decisions during maximum emotional stress. This virtually guarantees poor decisions. Social media is filled with people making extreme price predictions with zero accountability. Their motivation is attention, not accuracy. Base your decisions on verifiable data and your own analysis, not on the confident pronouncements of strangers. One analytical tool deserves specific attention: the gold to silver ratio. This ratio measures how many ounces of silver equal 1 ounce of gold. Throughout history, it has varied from 15:1 to over 100.1. Currently, the ratio sits around 80.1 or so. This means 1 ounce of gold equals roughly 80 ounces of silver. Some analysts view this ratio as a timing tool. When it reaches extremes, say above 100, silver appears undervalued relative to gold. When it reaches the opposite extreme, below 50, silver appears overvalued. But here's the nuance. The ratio tells you about relative value, not absolute value. Silver could be undervalued relative to gold, while both metals are overvalued relative to other assets. Or both could be undervalued together. The ratio is useful context, not a crystal ball. If you hold strong conviction about precious metals broadly, and the ratio suggests silver is undervalued relative to gold, it might inform your allocation between the two metals. But it shouldn't override fundamental analysis of whether precious metals generally offer good value at current prices. Rather than predicting the future, let's examine possible scenarios and their implications. Silver continues above $50 for an extended period. What would support this? Continued strong industrial demand combined with persistent inflation above central bank targets. Perhaps accelerating solar and EV adoption coinciding with prolonged geopolitical tensions. In this scenario, silver might establish a new trading range between $50 and $70 over the next several years. Silver trades between $40 and $60 for an extended period, neither breaking out nor breaking down significantly. This might occur if bullish and bearish forces roughly balance. Industrial demand remains solid, but investment demand cools. Supply increases gradually, but not dramatically. Consolidation frustrates momentum traders, but allows fundamental investors to accumulate or distribute gradually. Silver drifts lower over 6 to 18 months, eventually settling in the $30 to $40 range. This might happen if inflation continues moderating, economic growth disappoints, reducing industrial demand, or investors shift capital to other opportunities. Not a crash, but a slow deflation of the premium over fundamental value. Silver experiences a rapid decline of 30 to 40% within weeks or months, driven by leveraged position unwinding or a specific catalyst like a significant geopolitical de-escalation or surprisingly hawkish central bank policy. This happened in 2011 when silver fell from nearly $50 to $26 in a matter of weeks. Such moves feel catastrophic while occurring, but often prove temporary if underlying fundamentals remain intact. Nobody knows. Each depends on variables nobody can predict with certainty. The value isn't in predicting the scenario, it's in being financially and psychologically prepared for any of them. Let's address something that doesn't appear in fundamental analysis: crowd psychology. Markets are not pure mathematical systems. They're composed of humans making decisions under uncertainty, often influenced by hope, fear, and herd behavior. When silver surges, it generates its own momentum. Media coverage increases. Social media fills with success stories. New investors enter, attracted by rising prices. This can create a self-reinforcing cycle for a while. But sentiment-driven moves, by definition, lack solid foundation. When sentiment shifts, the support evaporates instantly. How do you know when sentiment has become excessive? Watch for these signs. Mainstream media running breathless stories about silver. Friends and family who never discuss investing asking about silver. An explosion of online experts guaranteeing massive profits. These indicators suggest the move has attracted maximum attention. Not that it must reverse immediately, but that much of the easily mobilized capital has already entered. Conversely, maximum pessimism often creates opportunity. When silver seems permanently broken, when nobody wants to discuss it, when media declares it dead, that's when fundamental investors find the best risk-reward ratios. Sentiment is impossible to quantify precisely, but paying attention to it helps you avoid the worst mistakes of buying at peak excitement or selling at maximum despair. Silver's reputation as an inflation hedge deserves scrutiny. In theory, tangible assets like silver should maintain value when currencies lose purchasing power. And historically, over very long periods, this holds reasonably true. But short to medium term, the relationship is complex. Silver performed well during the 1970s inflation, poorly during the inflation of the late 1980s, and mixed during recent inflationary episodes. Why the inconsistency? Because inflation itself isn't a uniform phenomenon. Cost-push inflation driven by supply shocks affects silver differently than demand-pull inflation driven by excessive money creation. And inflation's trajectory matters more than its absolute level. Rising inflation from 2 to 4% often supports silver more than stable inflation at 5%. Moreover, central bank responses to inflation heavily influence silver prices. If central banks aggressively combat inflation through tight monetary policy, this often pressures silver despite ongoing inflation. The relationship exists, but it's not mechanical. If you're buying silver purely as an inflation hedge, understand you're making a nuanced bet, not purchasing insurance with guaranteed payout. Let's get concrete about managing risk in silver positions. If you hold physical silver, storage and security become non-trivial considerations. Keeping significant value in your home creates theft risk. Using vault storage creates counterparty risk and costs. Neither is insurmountable, but both require thought. If you hold silver mining stocks, understand you're adding company-specific risk and operational risk on top of commodity price risk. Mines face labor disputes, political risk in developing nations, environmental challenges, and management competence issues. Mining stocks amplify silver's moves in both directions. They're not a safer way to own silver, they're a leveraged way. If you hold silver ETFs, examine expense ratios, tracking error, and the fund's structure. Some ETFs hold physical silver, others hold futures contracts that may underperform spot prices over time. Know what you own. For any silver position, consider using stop losses, not rigid mechanical ones that guarantee you'll be shaken out by volatility, but mental stops that define the point at which your thesis is invalidated. A stop loss isn't about avoiding temporary declines. It's about preventing catastrophic permanent loss if your fundamental analysis proves wrong. And finally, periodically rebalance. If silver appreciates significantly and grows from 5% of your portfolio to 15%, that's a windfall, but also an increased risk concentration. Taking some profits to restore your target allocation isn't market timing, it's discipline. Now let's synthesize everything into a clear framework. The data suggests silver faces conflicting forces. On the supportive side, industrial demand remains structurally solid, particularly from renewable energy. Real interest rates remain low by historical standards. Geopolitical uncertainty persists. Supply responds slowly to price signals. On the concerning side, silver has appreciated substantially, reducing margin of safety. Investment demand depends heavily on sentiment and macroeconomic fear, both of which can shift rapidly. Industrial users are actively working to reduce silver content. Speculative positioning is elevated, neither side dominates decisively. This means silver could easily trade in a wide range over the next 12 to 24 months. Neither a collapse below $30 nor a surge above $70 would surprise informed observers. The most honest answer to is silver going back below $50 is probably at some point, but possibly not soon and not necessarily for long. Silver is volatile. It will fluctuate. Asking whether it will drop below a specific round number is asking the wrong question. The right questions are, at what price does silver offer good value relative to your investment objectives? How much exposure makes sense for your risk tolerance and time horizon? What would invalidate your thesis? Answer those questions clearly, and silver's daily price becomes less important. Step back from silver specifically and consider what it represents. Silver, like gold, represents a form of portfolio insurance against monetary instability, currency debasement, and systematic financial risk. Unlike gold, it also participates in the industrial economy through real, growing applications. This hybrid nature makes it suitable for investors who want exposure to both precious metals' monetary qualities and commodities' growth potential. But it's not suitable for everyone, nor should it dominate any portfolio. A balanced portfolio includes multiple asset classes serving different purposes. Growth assets like stocks, income assets like bonds, real assets like commodities and real estate, and monetary assets like precious metals. Silver fits within this framework. It's not the entire framework. Investors who lose sight of this, who become precious metals, zealots convinced that gold and silver will solve all economic problems, typically underperform. Diversification isn't exciting. It's not intellectually satisfying to own a bit of everything rather than betting heavily on your highest conviction idea. But diversification is what survives, and survival over decades is what builds lasting wealth. So, is silver going back below $50? The intellectually honest answer, almost certainly yes, at some point in the future. No asset moves in a straight line. Silver's volatility virtually guarantees it will revisit lower levels eventually, even if the long-term trend is higher. But will it stay below $50? Will it crash back to $30 and remain there? Will it happen next month or next year? Those questions have no knowable answers today. And here's the liberating truth. You don't need to know. You need to know whether silver offers value at current prices relative to your investment goals. You need to know how much exposure makes sense for your situation. You need to know what would change your thesis. Answer those questions, and silver's short-term price movements become noise rather than cause for anxiety. If you bought silver because you believe industrial demand will grow for a decade, a temporary decline to $45 is irrelevant to your thesis. If you bought silver hoping to flip it quickly for profits, you're speculating, not investing. And speculation has its own rules that require accepting total loss as a possible outcome. One of the hardest skills in investing is patience. We live in a culture of instant gratification. We check prices constantly. We expect linear progress. We grow anxious during periods of consolidation or decline. But markets don't reward this mindset. They reward patient capital, deployed at good valuations and held through volatility. If silver were guaranteed to move in a straight line from $40 to $100, everyone would buy it and the opportunity would vanish instantly. Opportunity exists precisely because the path is uncertain and uncomfortable. Your advantage as an individual investor isn't access to secret information or sophisticated algorithms. It's the ability to take a multi-year view while institutional traders focus on quarterly performance. Use that advantage. If you believe silver has fundamental value, short-term price declines are opportunities to add exposure at better prices, not reasons to panic. If you're unsure about silver's fundamental value, declining prices are your signal to stay away until you develop genuine conviction. Now, what destroys wealth is the middle ground, holding positions you don't understand, driven by hope rather than analysis, causing you to sell at the bottom when emotions overwhelm reason. We've covered substantial ground today. We've examined silver's dual nature as both industrial commodity and monetary asset. We've explored historical precedents, market cycles, supply and demand dynamics, and macroeconomic forces. We've discussed strategic considerations for both current holders and potential investors. We've identified critical behavioral mistakes that turn market volatility into personal financial disasters. And we've addressed the core question, is silver going back below $50? Not with a prediction, but with a framework for thinking clearly regardless of what happens. Here's what I want you to remember most. Markets exist to transfer wealth from the impatient to the patient, from the emotional to the disciplined, from the reactive to the strategic. Silver will volatility, it always has. That's not a bug, it's an inherent feature of this market. Your task isn't to predict every twist and turn. Your task is to make rational decisions based on evidence, manage risk intelligently, and maintain emotional discipline when others panic. If you approach silver as one component of a diversified strategy, size positions appropriately, define your thesis clearly, and prepare psychologically for volatility, you give yourself the best chance of favorable outcomes over time. If you approach it as a lottery ticket, trade on emotion, use leverage, or bet more than you can afford to lose, you virtually guarantee eventual regret. The choice is yours. The market doesn't care which path you choose, but your future self will care deeply. Make decisions today that your future self will thank you for. Prepare for multiple scenarios. Accept uncertainty as the permanent condition of investing, not a temporary annoyance. And remember, the goal isn't to get rich quickly. The goal is to build and preserve wealth steadily over decades through multiple market cycles by making consistently rational decisions when others are making consistently emotional ones. That's the real secret, not predictions, not inside information, not perfect timing, just disciplined, patience, and rational thinking applied consistently over time. Silver's price will do what it does. Focus on what you control: your decisions, your position sizing, your emotional discipline, and your long-term perspective. Do that well, and regardless of whether silver goes back below $50, you'll be prepared for whatever comes next. Thank you for your time and attention today. Until next time, stay disciplined, stay rational, and stay focused on the long term.